Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in, take a look, see what is going on today. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics, share my opinions about individual companies with everyone in the community, investment opportunities using technical analysis and fundamental analysis, and answer your guys' questions on the weekends. On Saturdays and Sundays, they are recorded and uploaded to the website. And we also have midweek updates of individual companies. Specials, the coupon code that is active right now, so type in special to get a discount on both the monthly and yearly memberships. Starting off with Nostra, gold, the past and future of money. Few understand this. Well, I guess you don't have to put the past and the future. You can just say gold. It is the only money. It is an element on the periodic chart. It's worked through history, and it will most likely work in the future. Walter Bloomberg says appeals court temporarily halts ruling against Trump tariffs. Federal Circuit Court says it needs time to consider filings. I guess the court said that he cannot implement the tariffs. Now they're reversing it to some degree. I'm sure it's not causing any sort of volatility in the market, turning on and off. It's flip-flopping all over the place. Here's one. It says, is OPEC adopting a policy to kill the USA Permian oil while pretending to help? I don't think so. I think this is all fake news. I don't think we're pumping a ton more oil out of OPEC. I don't think they're exporting much more oil. I'll show you data below on exportable capacity. So be careful what you're reading. I know this is from oilprice.com. But we're seeing a lot of stuff come out about OPEC and the United States going to war over oil and the market share that these people have. Oh, they'll lose market share. I don't think it matters when you're below the cost curve. If you're below the cost curve, we're pulling back rigs. We are declining in drilling. So I don't know what there is to say. They're not going to get into a war here as the rig count drops. So I don't understand a lot of these articles that are coming out, and I don't think there's a showdown at all. I think it's all made up news, to be honest, because I don't see any follow through on either side showing me that they are actually doing some sort of showdown or doing anything. Rig counts dropping in the American companies. CapEx is falling. We will most likely see a decline in production at some point in the future. And exports from OPEC are not really increasing very much, which makes me think that they're not increasing production in terms of exports. So LNG QE says an excellent graph from Cheniere illustrating the U.S. LNG ramp in 2025 to 2029. This is what I call the wall of demand from LNG takeaway capacity. It says simple figures are roughly 11 billion cubic feet per day of incremental net gas demand. Note, this does not include Canada nor Mexico LNG, which combined add several additional billion cubic feet per day. So incremental capacity to improve near-term balances. This is the forecast that's coming, and this is the phases and some of the LNG terminals that are coming ahead of us. The average annual growth capacity is 3 billion cubic feet per day. LNG market's about 7%. That's 25 and 26. From 27 to 29, we get another capacity addition of 2 billion cubic feet per day. LNG market roughly 7%. So this is what's coming. Plaquemines, phase 1 and 2, Golden Pass, T1 to T3, Rio Grande, phase 1, Port Arthur, and Louisiana LNG, all coming online by 2030. That's the wall that's coming. Now, can we produce this amount of natural gas to feed all this? I don't know. We'll find out. We will find out. And I think it's a great investment opportunity to take part in this. Now, some people will say, well, you should invest in the LNG terminals. No, that's not what I want. I want direct exposure to natural gas, the pricing of Henry Hub natural gas. I also think eventually it will impact the pricing of Canadian AECO gas as well, AECO, AECO. Mr. Assam, however you pronounce it. Housing vacancy has increased 28% since the second quarter of 2022, despite the claims regarding shortages. Now at 8.2% combined vacancy rate and no sign of slowing. So this is what he is showing you, which is a very short-term graph going up and up and up. And that is true. It is increasing, and I'm sure that the percentages are correct that he is calculating. But when you take a bigger look at it, it says, come on, Mr. Assam. That's a little misleading. Single-family homes were 1.1%, historically very low, almost crisis levels. Multifamily was 7.1%, which is also fairly low, especially considering record supply hitting the markets last 18 months. So this up here is homeowner vacancy rate in the United States and rental vacancy rate in the United States. And it's over 8%. But if you look at the US homeowner vacancy rate, it's incredibly low in low area, and it was just coming from crisis level. So this has time to go back up. This is nowhere near 2008 or 7 or anywhere in that range. And it's at very low levels, much like the 70s, which we were squeezing up on the affordability back then. In fact, 1982 was the worst affordability looking all the way back in terms of affordability. This is vacancy rate, obviously. So it's still very low, and it's not in bubble, we'll call it bubble territory. Bubble territory is if this just keeps going up and up and up and up, which might take 3, 4, 5, 6 years. Who knows how long? Might take some time. It could happen quickly, but you have to watch and see. This is, oops, someone forgot to tell OPEC to flood the market. Oh, they're having a huge showdown here. Look at May. Yeah, just a huge amount of exports just hitting this market. Remember all the people that were worried about all of OPEC increasing production? What if it was just paper barrels? What if they were just squaring off the people that were cheating? Looks to me like we've got exports declining here, not going up, which is kind of interesting. Warren Buffett says, keep things simple and don't swing for the fences. When promised quick profits, respond with a quick no. So I think he's very doubtful of people who say that they can profit quickly. Oh, hey, I can read some charts. We'll just time the market. And guess, a lot of people are very, well, not a lot of people. I'll just say Warren Buffett doesn't think you can time the market in the short term. Neither does Peter Lynch. They don't think that they can call recessions with accuracy. And all I see on YouTube, a lot of the people, they're all making predictions. Well, this is going to happen, and this is going to happen, and this should happen this year. And then they put price targets on everything. That's not how the rich guys do it, guys. It's not how they operate. They don't put price targets. They don't do whatever. All they do is they say, is this thing undervalued? And if the answer is yes, it's way undervalued, then they see, okay, what's market sentiment? Is there fear in the market? What they try to do is make all their money on the buy. The buy and how they make their money is by buying things when they're way undervalued. That's how they're doing it. And then they just hold on. They don't play the game of trying to make all these predictions. Now, some people in the market will make money off of predictions, whether they did it on purpose or not. By sheer luck, People will make money, and some of them could make copious amounts of money in very short periods of time. But that doesn't mean it's that you can replicate it over and over. So if you've got a stock that can either go up or down, there are people making bets. Some people will bet that it goes up. Other people will bet that it will go down. And just because they made their bets and just because there's reasons behind those bets doesn't mean that if the stock goes up or down, that any of those reasons are actually right. The difficult part is to have a strategy that you can replicate over time and consistently make money. And there's a whole bunch of different strategies. It's not about getting lucky once or twice. And the best short-term trader, a lot of people, at least in history, called Jesse Livermore as one of the best traders. And this guy went broke 3 times throughout his career. So the question then becomes, was it luck or was it skill? If you went broke 3 times in a row, that means that strategy is closer to a gambling strategy than it is to a strategy of building wealth and compounding. So I'm on the camp that the trader side is a little bit too risky because you've got a large chance of blowing up. And then what they'll say is, we'll put stop losses and all this other stupid garbage, which I don't believe in. But if you look at undervaluation and you do the Warren Buffett approach or Peter Lynch or Howard Marks or whoever else, that seems to be a repeatable strategy where you don't blow up either. Peter Spinia says, Goldman urges investors to buy gold and oil as long-term hedges, citing that the appeal of bullion as a haven amid concerns over U.S. institutional credibility and crude's ability to protect against supply shocks. Yes, we are going to get supply shocks. Yes, crude oil is going to go way up. And yes, gold and other precious metals are going to protect you against the system. The design of the system, and I've talked about this before, is to increase credit for the system to survive. You need more credit coming into the system, piling on in, because the credit or paper dollars do not exist to pay the interest back. So you really need to pump the system with that currency, paper dollars, in order for it to not implode on itself. Oil is the balancing factor of credit creation. Oil and GDP are linked 95% plus for an R-squared value on a linear regression analysis. It means that oil is GDP and GDP is oil. If oil can't keep up and we get supply shocks, then your whole system is at risk of massive inflation. That inflation will work its way through oil first, and then through all the other stuff in the system. So yes, oil is a huge deal, and I think that physical metals is a huge deal. We can see these big patterns all forming. Gold's already broken out. I think that's front-running it all. Silver's going to break out of the cup and handle. Platinum's broken to the upside. Palladium, I'm sure, will follow. And they're all going to rip higher. Everything. Why? Because people need to find a way to store value if oil goes down. What that means is that bonds, stocks, and even debt, which is paper money, the dead presidents with numbers on them, that's all going to come under scrutiny. What is a stock worth if you don't have oil to feed the system? And remember, it's all predicated off of future growth. A dollar is the promise to pay something in the future. But what if that future is smaller, at least if people perceive that the future is smaller, because you don't have the energy supply to ramp up exponentially like the system demands for its currency? So that's where things start to get all out of whack. This occurred in 1970 with America oil peaking. It occurred in the mid-2000s with conventional oil peaking, and now it's the entire world. Says, surprise, where is the oil? Daily energy report, and this is OPEC plus crude oil exports. Where's the oil? I thought we were going to get these huge increase in exports. It hasn't come yet, so we'll see if it's delayed and it's on tankers. Maybe, but we don't see it yet. This is the U.S. Department of Energy stocks for week ending 5/23, 2025. We've got a crude draw of 2.8 million barrels, gasoline draw of minus 2.4, distillate draw of zero point 0.7, and Cushing up a little bit. Crude ex SPR, I think that's down 2 million, and maybe they released oil. I don't know. But this is crude stocks down 2.8 million barrels right there. We've got gasoline stocks towards the lower end of inventory levels. Distillates way low, below the 5-year range. Cushing stocks are low, below the 5-year range. Refinery runs, we're running refineries up at the upper range, which means we're pushing and taking oil and converting it to final products, but we're just sucking it all down on the back end. And then crude production is flat to slightly down for the United States. The Uselink TA, this is update for coal. Coal's looking good. We're breaking through the downtrend, and now we're trying to break through this horizontal resistance line. And hopefully we can break through it. We can also see it's a falling wedge into a corner if you look. Newcastle Coal Futures looks good. Howard Marks on humility as an advantage. He says, overestimating what you're capable of knowing or doing can be extremely dangerous. Acknowledging the boundaries of what you can know and working within those limits rather than venturing beyond can give you a great advantage. And I've been contemplating this quite a bit. What are those limits? And is it worth pushing certain indicators? So, for instance, a lot of people only look at technical analysis. I don't. I look at technical analysis and fundamental analysis, and I listen to insiders during their quarterly earnings calls. I'm trying to figure out, I want to see the technicals and the insider information match. But where does the confidence end and begin? How far can we push technical analysis? How far do we push fundamental analysis? The technical guys will say fundamental analysis is a waste of time. The fundamental analysis guys will say technical analysis is a waste of time. But what if you could use both? And what if they're both right and both wrong at the same time? What if you need technicals to see that you've got a long-term bottom? What if you need the fundamentals to ensure that you have a low risk entry point and that you're not buying an overvalued POS garbage dilution machine? What if there's a way that you can combine everything to increase your odds in being successful? What if learning about the company and listening to the conference calls and reading their presentations, that's not going to give you a disadvantage, is it? So why not do it? So where are the boundaries? What is worthwhile putting your efforts into, and what are some of the things that you want to skip over? And if I were to kind of sum it up, I think doing super deep dive fundamental analysis is probably a little over the top. If you're working in the commodity group, the commodity price is really what you need to know. You need to know the cost curves and all that other stuff. Then you need to know if the company is making money or not. Where's their break-even point, roughly speaking? You don't have to be perfect. What people would say in engineering is analysis paralysis, where you analyze too much and you don't know what to do because you're analyzing so many different things. A thing that I have found is the quicker to get up and running, so to speak, is to just try things, see if they work. If you've got 4 or 5 different ideas and something is very easy to try, well, try it out, see if it works, and if it fails, at least you know that option doesn't work. and then you can go a different direction. I think that technical analysis can work. It can get you to a company very quickly. Then you want to dive into the fundamentals and start looking. And that's kind of that's been my approach, and that's how I do it. But it still doesn't mean that it's perfect. So where is the boundaries? How far can you go? When is it okay to overweight a company and really load into it versus underweighting it or being more cautious? That's something that takes years of experience in trial and error. And that's some things that I go over on the website are some of those things. Here's platinum for Bob Coleman. He says, incredible declines in physical inventories at the NYMEX. Over the last 6 weeks, platinum registered inventories declined 44% and eligible inventories declined 32%. I've been pointing out that the platinum story for a few months. These types of declines are indicative of either increasing investment demand or industrial fabrication picking up. The price has reacted to that accordingly. So we're starting to see some declines in inventories of platinum. And we are breaking out of a squeeze in the platinum story. Logan says, I'm very happy with the inventory story of 24 and 25, but consider the escape velocity in 2005 and 7 in active listings compared to today. And he's talking about this big move and breakout higher. We haven't had that breakout yet, and we're at a very low level of total housing inventory. So we're not in a dire situation, but we could break higher. And if we do, maybe that is the signal. So let's wait and see if we get the signal. Grady says, been posting many charts that shows that this lifetime commodities opportunity is about to once again go into overdrive. Been saying and posting that a big move in the TSX Venture is coming and is now started. Shoulder, head, shoulder, and a breakout of the neckline, and that's ready to go higher for the smaller Canadian commodity companies versus the commodity index or the CRB. We can also see that the Canadian dollar is about to break out against the US dollar, which is another indication that we could see a big move and money flows into the CDNX. Freight futures AM, we've got dry bulk that's flat on both Capesize and Panamax, and tankers are both up a little bit, 1% and 2% for VLCC and Suezmax. Another one from Grady, it says all these precious metals ratio charts below were pieces of the puzzle for us at the service. When we nailed the start of the big move back in early of 2024, which meant huge profits, the global capital rotation into precious metals is starting now, or is not starting now, nor is it confirmed now. It started when these ratio charts below turned, which I posted in real time back for each chart. The confirmed capital rotation turn is not now. It happened many, many months ago. Posted these charts earlier saying that we're about to break out. They have now done that, all of them. Very few believed it when I posted it, but that is how it must work. Most have to be wrong at the wrong end of the sentiment at big levels, breakouts and turns, including analysts, experts, and services. Among many other clues for this was that gold had an 8-year cycle low back in 2022. Plus, we broke out of a 13-year bullish pattern 15 months ago, which I posted on when it happened. It means that gold is only 2.5 plus years into the present 8-year cycle, and that it broke out of a 13-year pattern base 15 months ago. With a bullish backdrop like that, plus many other significant clues, if one knows where to look, then do not listen to the ones calling for outrageously low numbers during the declines, since gold is now in a resumed raging bull market since 15 months back. During the huge up move the last 15 months, most have been, as usual, preoccupied with listening to attention-seeking narratives about impending stock market crash, constant talk about metals manipulation, many calling for lower and USD going to the moon instead of understanding what is actually happening. So here's the charts. He's used the Huey versus the semiconductors, which he showed. First Majestic versus NVIDIA, which is a false breakdown ready to break higher against NVIDIA. We've got gold versus the SPY, which is the S&P 500, and GDX versus SPY, and everything has broken to the upside. It is all good to go. Now what you want to do is do nothing. You should already be positioned, and we should be just sitting in it, waiting and collecting. Now, there are some lagging companies that are out there that we can still participate in. The big boys have already run. The mid caps are running. But there are some smaller companies that haven't run yet. They're still at bottoms of patterns. Very similar to like bottoms like here, or in corners squeezed up. Those are your opportunities. In fact, I've got a small junior silver company that looks really good at this moment. And if you're part of the website, you guys know which one I really like. That looks really good. We're entering the bid first, ask questions later phase of the precious metals cycle. FOMO is brewing. Junior miners look explosive across the board. Shoulder head, shoulder inverted, ready to end breaking higher of the shoulder with volume ramping up. Looks pretty dang good. And this is I think this is the S&P TSX Venture. So Canadian, it's the same one as this, the CDNX, which is above. Another one from Grady. This is the junior gold miners. Posted on the 3 breakouts above the blue, purple, and black lines. Then it is back tested the black line here, which is this guy going across. It means the last big resistance is cleared and it is now ready to start the big move. I hope you listened and made big profits from my posts up from the very lows. Most will miss most of the bull market as usual, though. So for heaven's sake, take notice now, if not before, and get proper guidance for the bull market. So this is GDXJ. It is ready to rip. There's a couple that we purchased at the bottom for silver juniors. They are up, 300% plus. They look fantastic to run again, and they're right at the top of this, just like this is. And then we're going to see a very big move, and hopefully a lot of the people on the website, hopefully they get 10, 20x returns on those companies. And I hope you guys can hold on and get those returns for yourselves. API numbers, we had a big draw here, about 4 million barrels, and then a little bit less here. And really the difference is that EIA has some crude. They were like 2.5, but it went to the drawdowns in gasoline is what they have. But that's all I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Use that special coupon code. We've got a question and answer session at 5 p.m. Mountain Time on Sunday. All right, guys, that's all I've got. We'll catch you next time.